Welcome to this short executive knowledge lecture on topic 5 of paper 3. Now this topic covers record keeping and contract limits and reporting. And the material in topic 5 is not that long. It's a relatively short topic, but you're going to be looking, I would say, at around 7 questions. So like topic 3, this topic is well worth getting on top of because you get a high hit rate for the time invested. And we can contrast that with topic 4 previously, which is a lot more material and around about 7 or 8 questions. So bear that in mind when you're allocating your study time. Now, I will emphasize the important points to help you understand the core material you need to know to sit the exam, and as ever, a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Paper 3 resources. And again, as ever, I strongly recommend that you supplement this learning with question practice, and we have hundreds of practice questions on Examinator.online. Now, there are 3 sections to topic 5 that we can see on the screen: records to be kept by intermediaries, contract notes, statement and receipts, and then contract notes, limits and reporting. Now, there are 2 sets of rules, in fact 3 sets of rules, and there is code of conduct and guidelines that we have to be aware of. And right at the outset, I would remind you that rules have the force of law, whereas code of conduct and the guidelines do not. So let's start with records to be kept by intermediaries. And what we're considering here in the main are the keeping of record rules. And right at the top of page 5.2, we're reminded that these rules require intermediaries to maintain comprehensive records relating to their business and client transactions. The records must be in sufficient detail so that you can see what is going on and that the accounts can be prepared. Generally, and this will repeat itself, records should be kept for 7 years, although there are some relaxations on that, and we will cover them as we go through it. And records must be written in Chinese or English, or which is most common in electronic form that we can convert into writing. Now, under the keeping of record rules, what are the records to be kept? It must keep sufficient accounting, trading and other records in accordance with generally accepted accounting practices, GAAP, in sufficient detail to basically explain and show the performance of the business, explain the client assets, movement and assets, etc. They're listed there, and I'd say that most of those are business common sense. But then we get into some of the particulars that should be recorded under the keeping of record rules, and we're told the particulars should be there of all money received and disbursed, all income received, all expenses, commissions, etc. And I don't think there's anything there that is unusual. Right at the bottom, last bullet point, page 5.2, I have seen this examined as a specific question. Records of all contracts, standing authorities, written directions, and evidence of professional investor status must be kept. So keep those points in mind. Now we come to the requirement in the keeping of record rules with regard to margin transactions. Now this is very important for paper 3 because futures trading, you have to collect margin, initial margin from the clients. So please keep this point in mind. Records must also show particulars of market value and margin value of each type of securities collateral deposited. Remember, securities collateral will be deposited as margin. Total aggregate market value and total margin value of such securities collateral, and details of margin calls made. Now, I'm emphasizing these points because I've seen a question on this many, many times. The question will state which one of the following does not have to be kept. Records do not have to be kept with regard to margin transactions. Now, these 3 points are listed, and the one that is incorrect is total option premiums. They don't insist on total option premiums being shown. You may not see that in your exam, but I'm contributing it nonetheless. 1.5, under keeping a record rules looks at associated entities. And remember, associated entities, they're not licensed. They're usually owned by the intermediary and they hold client assets. These entities must also keep records in accordance with GAAP to account for all client assets, etc., etc. Once again, a list of requirements for keeping records by associated entities. Now, we're just going to step out of the keeping of record rules for 1.6. We'll come back to them at 1.7. But paragraph 1.6 on page 5.3 details the requirements under codes and guidelines, code of conduct and SFC guidelines. Remember, these do not have the force of law. So the code of conduct requires intermediaries who are participants of the futures exchange. So that's those firms that deal directly with the futures exchange. They must maintain proper books and records which correctly and clearly record. Now, there's going to be a certain amount of overlap here, but it's very specific to the futures participants. Financial position of each client's trading account, time, date, and complete particulars of instructions received and trades executed, particulars of intermediary and client open positions, amount of margin deposited with clearinghouse and individual agents, amount of variation adjustment and interest rate cash adjustment paid to clearinghouse and each executing agent. We're getting very detailed. Amount of margin deposited or required to be deposited for each client, amount of variation adjustment collected or required to be collected from each client, all payments and assets received or held to satisfy margin requirements. You will see margin coming up again and again. Particulars of margin calls and demands for variation adjustments, and any other particulars as required from time to time by the futures exchange. So this is under the code of conduct with regard to the records that have to be kept by a futures exchange participant. Continuing under the code of conduct, top of page 5.4, client ledgers. Now, I would say there's always a question on client ledgers, so be aware of these points. So the code of conduct require intermediaries who are participants of the exchange to maintain separate ledger accounts for every client for the futures exchange, non-futures exchange, and all other trades. So separate accounts for each category. Why do we have to do this? We'll see in a moment. Record details of all collateral received from clients and send statements to clients with details. Okay, fair enough. And here's the third point, an important point. Segregate clients' ledger accounts for futures exchange, non-future, and other accounts. Well, that was the first point being repeated. So there is no offset between accounts. That's the important point. If you've got debits in one set of accounts, credits in the other set of accounts, you cannot offset. They must be kept separate. And that has been highlighted in questions in the past. 1.6.3, again, code of conduct requires orders, confirmations received or given by telephone. Those records must be kept for 6 months. So that's not under the keeping of record rules. That's under the code of conduct. And with regard to advisors, we now move to the internal control guidelines that have been issued by the SFC. They are required to record advice given, explain reason, basis for advice, and the records should show compliance with the code of conduct general principles, including suitability of advice and acting with due care and skill. I beg your pardon, due care and diligence. Okay, so paragraph 1.6 and the subparagraphs are relating to the code of conduct, which doesn't have the force of law. Going to paragraph 1.7, we're now moving back to the keeping of record rules. And none of these rules with regard to retention time, records should be kept for not less than 7 years. We visited that at the beginning of this topic. Client orders and instructions, contract note, statement of account, and receipts, they only need to be kept for 2 years. So the default is 7, but some very specific records only have to be kept for 2 years, and they are listed there. Miscellaneous points under the keeping of record rules, records to be kept in Chinese or English, Documentary assurances for short sales only need to be kept for 1 year. That's a very specific point. It is highlighted in the notes, so be aware of it. And then, as with other rules, reporting of non-compliance must be done within 1 business day, and there are penalties if you fail to comply with the keeping of record rules, and if fraud is involved with failure to comply, there can be fines and jail time. You can be imprisoned. Okay, that was the keeping of record rules. The second set of rules that we need to be aware of, the contract note rules. Now that's the contract note statement and receipt rules, but we condense it just to the contract note rules. So you need to know the keeping of record rules. You also, at topic 5, need to know about the contract rules, contract note rules, and that's what we're looking at now. All intermediaries conducting the business of, and they just list the ones you have to be licensed for and all the ones that are specific to paper 3, dealing in securities futures, securities borrowing, etc. You must provide to clients, either in English or Chinese, contract notes, receipts for client assets received, monthly statements, and daily statements if relevant. Well, at topic 5, paper 3, they will be relevant because we're into the world of margin, and I will explain that further in a moment. Now, professional investors do not need to receive these documents, contract note, statement of account, etc., as long as they agree. More specifically, and I'm going to highlight these points, if professional investors are defined in the SFO, Securities and Futures Ordinance, which means they are institutional professional investors, then the intermediary has informed them in writing and the clients do not object, then you don't have to send all these documents. If the professional investors involved are defined in the professional investor rules, that covers corporate professional investors and individual professional investors, and the clients have agreed in writing not to receive these documents, then you don't have to send them. So for the institutional professional investors, you inform them you're not going to send them and the clients do not object, then you're okay. However, with the corporate and the individual professional investors, they have to agree in writing that they're not going to receive these documents. That can be examined if it comes up. It would be 1 question. Contract notes. So what's the material with regard to contract notes? Contract note must be issued whenever an intermediary buys or sells future contracts, including transaction under the securities borrowing and lending agreement. So securities borrowing and lending, contract note is also applicable. Intermediary must issue contract note detailing a single transaction or all the transactions on the same day, unless the client wants individual contract notes, and you've got to send it to the client T+2 by the end of the 2nd business day after the transaction. Now, what must appear in a contract note? And this can be examined, and this is quite nasty because there's a lot of detail. Can you remember it all? Maybe, maybe not. You just have to be aware that it can come up. So a contract note must contain the name and account number with regard to the client, intermediary's trade name, date of contract and settlement, and full particulars of the contract, specifically the quantity, name, description of the futures contract, price per futures contract or average price per contract, name of any agent involved in either dealing or clearing, name of market exchange on which it was executed, whether the contract is for opening, closing a position, commission payable, charges and stamp duty, notification if intermediary is acting as a principal. Whoa, do I have to go into the exam with all that in my head? I'd be aware of it. I'd read through it. I'd do the practice questions that cover the contents of contract notes, and then I'd do my best in the exam as I can. I would not be sitting memorizing all this detail, but I am highlighting the point that we have seen this examined at paper 3.